Welcome, everyone. We're so pleased to have so many people registered for the Asia Pacific launch of the Global Primer on Directors' Duties and Obligations as they relate to climate change. This has been issued by the Climate Governance Initiative in collaboration with the Commonwealth Climate and Law Initiative. My name is Sunita Rajakumar, and I am from Climate Governance Malaysia.
And I'm David McElrea. I'm from the Australian Institute of Company Directors. We're very pleased to be part of this launch and to support the primer. We are shortly to become the Australian host of the Australian chapter of Climate Governance Initiative. So there's more to come in this space in Australia and across the region. So please keep an eye out for that. We'll be working with many partners who are involved in this primer to produce more resources. And we're really excited about being part of a broader Asia, Southeast Asia in particular, but Asia and the Pacific community, looking at these issues of climate governance and how they relate to the role of non-executive directors and how they make their decisions.
We have a great panel today to look forward to, comprising the highly respected Sarah Barker of Minter Ellison, the Asia Pacific Head of Investment Stewardship at BlackRock, Amar Gill. The session will be moderated by Shai Ganu of Willis Towers Watson.
But before we hear from those panelists, can we have a warm welcome to the chair of the Global Climate Governance Initiative? She's personally, I know, spent hundreds of hours, maybe not hundreds, but a long time personally preparing this primer and getting everyone together. And she was really directly involved. So can we hear from Ms. Karina Litvack?
So why did the Climate Governance Initiative decide to commission this legal primer? Quite simply because it was the first and most stubborn obstacle that faced directors when they were looking at the climate issue. I found directors were saying to me again and again, "You're asking me to take decisions on behalf of my company that go way beyond what the law requires today, and are going to put me in the position of leaving profitable business on the table. That is contrary to my legal obligations. I risk being removed from the board. I risk even litigation for failing to, fulfill my obligations. It's not going to happen." So, we realized quite early on that unless we overcame this particular obstacle, we were not going to make any progress. So commissioned this primer from the Commonwealth Climate and Law Initiative, which brought together a team of lawyers and professors of law. We also reached out to experts in 20 countries plus the European Union, because the CCLI only had contacts in Commonwealth countries. So we made sure that we had a 50-50 balance of countries from both civil law and common law jurisdictions. And our goal was to produce something that was accessible to the ordinary director. In other words, you do not need to have a law degree to understand these issues. There are a growing number of expert opinions out there. We have Australia, Canada, Singapore, the US is in the process of being produced, which run to 30, 40 pages. It's not the sort of thing that your average director is going to want to read or will understand. So this is very clear, very readable, and goes into the detail of each of the countries that we have covered. Naturally, once we started, more and more countries called up to say, "Can we please join?" And from our original group of a handful of countries, to be illustrative, it became 20 countries, plus the European Union, as I mentioned. The other wonderful thing that came out of producing this primer is that it opened up the channels of communication with institutes of directors with whom we had not been involved previously. So New Zealand, Vietnam, Singapore, Thailand, India, these are all the institutes of directors of all these countries have jumped aboard and supported this initiative. And we're in active discussions with the Australian Institute of Directors, which is planning to launch its own chapter of the CGI at the end of August. But it didn't wait to launch to support this primer, and is participating and sharing it with its members. So next steps now. One of the I think, frustrating experiences of preparing this primer is that just as we thought we were ready to go to press, more of our writers would come back and say, hold on, there's been an update in my country. I need to update my section. And this happened time and time again. So we finally said, stop, and we'll produce, periodic updates on this thing. It'll be a live document, which will include references to changes in law, changes in legal precedent, news about litigation. And because the incidence of litigation is increasing, we will probably do a special focus on this topic at some stage, because it is really grabbing the attention of directors. So one topic that we're definitely going to do a special focus on is this new phenomenon of the Say on Climate shareholder proposal. This is the idea that companies, usually willingly, but sometimes not, have a resolution on their ballot at their annual shareholders meeting, inviting shareholders to vote in favor or indeed against their climate transition strategy. The companies that willingly agreed to do this year, there were oil and gas and mining companies in Europe, all got extremely high votes in favor, and I mean in the 98%, even though a number of investors expressed reservations about the completeness, the ambition of their strategies. However, the fact that these companies were making themselves transparent and accountable to their shareholders warranted investor support, and that is what happened this year. So this is something that we expect is going to spread. It didn't go down very well in the United States. Not a single company accepted to do it, but this cat is now officially out of the bag, and I think we're going to see a whole lot more focus on this. So with that, I want to wish you all a very successful session. I want to welcome our new IODs today from Australia, New Zealand, Vietnam, Singapore, Thailand, and India, and hand you back to your wonderful panel. Thank you.
Excellent. Thank you very much, Karina. And again, good morning, good afternoon, good evening, everybody. I know we have a few hundred registrations from across the world, so whichever time zone you're in, thank you for making time for today. Very warm welcome to today's event, and I'll invite the panelists to switch on their cameras so that we'll launch into this. But very quickly, to introduce myself, my name is Shai Ganu, and for those of you who know me, I'm not really shy. I work for Willis Towers Watson, which is a global professional services company, and I lead our executive compensation and corporate governance practice globally. I am based in Singapore, and I also serve on the governing council of the Singapore Institute of Directors and on its ESG committee. And speaking of which, it's as Karina mentioned, it's great to see such strong support from director institutes across APAC. So thank you again for supporting this cause. Now, getting to today's panel. As Karina mentioned and Sunita and David mentioned earlier, climate change has moved from an ethical or environmental issue to a critical consideration in the way boards oversee risk management, strategy, and corporate disclosures. Yet, many directors are unaware of how these risks relate to their legal duties and disclosure obligations. We often hear directors assume that by pursuing zero carbon business strategies, they may need to, quote unquote, leave profitable business on the table. And in doing so, they potentially face the risk of removal or litigation. And so that's the focus of today's panel discussion, to deep dive into directors' duties, legal responsibilities, and disclosure requirements. And I'm pleased to say that we are very fortunate to have a stellar panel for you today, who will provide multiple perspectives that cover different views, the legal view, the investor's view, and the non-executive director's perspective. So in this context, let's start with Sarah Barker, who's a partner at Minter Ellison and who is also the author of the Primer's Australia section. Sarah, let's start with a broad question. Is it possible for you to kindly summarize the key findings of the Primer across these multiple jurisdictions?
Thank you very much, Shai. You might actually think it's close to impossible to summarise the findings across so many different jurisdictions. But actually what we found is there is incredible universality across all of these jurisdictions in terms of the underlying principles of corporate governance and directors' duties that apply. You might not be surprised to see that kind of uniformity across common law jurisdictions in the Asia Pacific, like Australia and New Zealand and Malaysia, Hong Kong, etc., etc. But also in relation to civil law jurisdictions like Japan, we can still see this universality. So why is that? And it's because in every jurisdiction, directors are fiduciaries of their company. And the corporate governance regimes all across the world are directed to providing some kind of guidance for directors on what the nature of being a fiduciary means for them in practice. So in each country, we have two sets of broad duty. The first is in relation to trust and loyalty, because as a fiduciary of your company, it needs to trust that you will prioritise its best interests over those of either yourself as a director or of those of any other third party. And the second set of obligations relates to competence, often given flesh as a duty of due care and diligence. So in all of the Asia Pacific jurisdictions subject of the primer, there were all obligations in relation to loyalty, best interests and due care and diligence. What does that then mean when we're looking at climate change? Well, we know that climate change has evolved to be a financial risk issue. And so therefore, it is indisputable that a consideration of climate change as a foreseeable financial risk issue is squarely within the best interests of a corporation. Once we pass that threshold, what's the second half of the duties in relation to competence? Exercising the degree of due care and diligence that a reasonable director would exercise. And again, as climate change has evolved and continues to accelerate in terms of its magnitude as a financial risk, so too the standard of care expected from directors in each jurisdiction subject of the primer has continued to elevate. So in short, in the best interests of companies across the Asia Pacific region, and secondly, the standard of care to which directors are held in considering how these issues impact on their countries continues to elevate.
Excellent. Well, thank you for starting us off at such a sort of universal commonality theme. Maybe just building on that, and let's get the big questions out of the way. So based on what you shared, what's your view about this conundrum that directors claim about being legally prevented from leaving profitable business on the table? And conversely, is it a valid concern to be worried about facing accusations of breach of duty if they act to reposition their companies for a zero carbon world?
I do understand those concerns, Shai, but as a matter of law, they are unfounded. If we look at two things, first of all, climate change is a financial risk, and it manifests not just in the long term, but also over the short and medium term time horizons within mainstream investment time horizons. Secondly, the law does not oblige directors to make any particular decision. It is an obligation of robust process, not of dictating outcome. So what directors need to ask themselves is, how robust is our process? How robust are the assumptions that go into our strategic planning, our risk management, for example? And have these been made contemporary by reference to the forward-looking challenges associated with climate change, the physical risks, the economic transition risks? So the question really is, before you get to the answer, the outcome, what your strategy going forward will be, to discharge your duties, you need to reconsider the inputs. Do we understand what it means for our cost of capital, the availability of insurance, useful lives of our assets? Because the one thing we do know about climate change, of course, is that history is not a valid analogue for what we're going to see economically going forward.
Brilliant. Thank you. I think that is counsel well taken. And I suspect I dare say we'll come back to this sentence that I noted down, that as a matter of law, some of these concerns may be unfounded. We may come back to this later on, but just a quick call out to all the participants. Please feel free to use the Q&A function to ask any questions, the chat function. I'll be monitoring those, and then we'll leave sufficient time towards the end to address as many of the questions as possible. But then, building on from what Sarah shared, let's turn to Sunita Rajakumar, who is a board director, is the founder and chair of Climate Governance Malaysia. Sunita, in your experience of speaking to fellow directors, how aware are they of how their duties might change in light of new developments in investors' expectations and developments in their companies' ecosystems relating to climate change?
So I think in terms of awareness, there's a very clear flow of logic. If you are convinced that we are facing an existential triple crisis, climate, biodiversity, pollution, if you're convinced that this part of the world is disproportionately affected, if you think that we are lagging in adaptation efforts, and that we are also lacking access to real-time granular data, which can lead to better informed decisions and better allocation of capital, if you think that your products and goods are no longer going to be welcome in our largest trading partners who have declared climate ambition and don't want to be accused of outsourcing their carbon footprint, then you cannot hope for different outcomes by carrying on in the existing trajectory. And this realization is needed, mainstreaming climate conversation, before directors can recognize the reality of this set of existential risks. If there is a break in logic somewhere, for example, you don't have access to numbers which are going to help align behaviors, or you're having difficulty developing scenarios which are going to steer the allocation of capital, then it is going to be difficult for directors to be fully aware and to comprehend the full extent of this triple crisis. So there is much capacity building that's needed. Climate governance has benefited tremendously from being housed virtually under the Institute of Corporate Directors. They are working really hard. This small team of dedicated people are working hard to professionalize directorships. And we're lucky also that we have the support of regulators, because they can see that this is a systemic risk to the financial system. So whether it's the central bank, Securities Commission, or the stock exchange. And the government also recognizes that this needs an all of government, whole of society approach. We have, CGM is staffed entirely by volunteers, and we're running a number of primers. We're trying to launch the ASEAN network. So there's quite a few initiatives running to build capacity in this space, right?
Absolutely. And you in particular, I know you're too modest to share that, but you've been an absolute champion for this cause. And the personal effort and time that you dedicate to this has been nothing short of inspirational. So thank you again, Sunita. This is great. Maybe just shifting gears and moving to the investors' views. So question to Amar. I'd like to call the third panelist, Amar Gill, who's the MD Stewardship at Asia Pacific at BlackRock. Amar, welcome, first of all. And the question is, how would you characterize the implications of climate change for the global economy, the global financial system, and the financial performance of individual companies? How have your expectations of boards evolved in respect to climate issues?
That's a very broad question, Shai. Thank you very much. I don't know how much time you've allocated me. I hope the next hour and a half is for me now. The impacts are huge. If you look at physical risks that are happening, that companies have to grapple with, typhoons are getting stronger here in Hong Kong, ripping through Taiwan, Japan, and a lot of this is basically because of warmer weather taking up more moisture into the air. You've got firestorms in Australia, California. All of this is leading to huge risks for insurers, but also for companies and the banks that are providing investments in areas that are being affected in various ways. So the physical risks are there and getting more and more apparent every day. Transition risks is the other aspect that I think a lot of the directors in emerging market companies have to keep in mind. And transition risks come from the fact that the targets being set by the regulators and the political leadership are moving up. You know, September last year was when Xi Jinping announced net zero carbon target for China 2060. And after that, a number of other countries have also become more vocal about their net zero targets. It means that all the companies have to look at their investments and whether their investments are going to have the lifetime that they expect them to have. So if you're building a coal-fired power plant today and expect it to be commissioned sometime in the next 5 to 10 years, and then have a operating life for the next 30 years, but in the next 2 to 5 years, the government changes the energy policy while you've already committed most of the investment in this coal-fired power plant, that's negligence. That's a dereliction of duty. And we expect the whole board, not just one individual which has some experience in climate and environmental issues, but we expect the whole board should be fluent on climate issues and understanding how the risks and opportunities, because there are also a lot of opportunities, how these risks and opportunities impact the company and its business. I go back ultimately to what our chairman, Larry Fink, put in his letter to CEOs last year. Very short sentence from that letter. Climate risk is investment risk. And for asset managers, it is an important part of the risk-reward equation. Similarly, for companies and the boards that set the policy, the climate risk is one part of the scale that you have to weigh against whatever potential returns that you're looking at in various projects.
Brilliant. And I like that sentence a lot. Climate risk is investment risk. So it's companies' focus on this issue is not out of the goodness of their hearts or not because of alleged altruism. It is a real financial, tangible risk and potentially, like you said, opportunity. And I think that proposition is very well understood. Interestingly, at Willis Towers Watson, when we think about sort of the risks that are associated with climate, we think about physical risks, transition risks, and liability risks. And what you were referring to about the entire board being conversant or actually being competent enough when it comes to climate issues also touches to some of the liability risk elements. Thank you for that, Amar. That's really helpful. We'll come back to that. But maybe just going back to Sunita. And Sunita, based on the comments from Amar, is it fair to say that the board's role in dealing with climate change is still an emerging issue in APAC region? And I fully appreciate that APAC is not a homogeneous region. You have different levels of maturity and also different governance regimes. But where companies may not be as concerned about the climate risk, or at any rate, they may not regard it as a responsibility of policymakers. Several policymakers have not yet committed to net zero targets. What do you see in that context? Have you had the opportunity to discuss this issue with fellow directors? What attitudes do you encounter? How aware would you say the directors are of their legal obligations when it comes to climate change?
So we've been very fortunate because the Malaysian Institute of Directors is actually reaching out to IODs in the region to try and come up with an ASEAN network of IODs. So we're trying to plug ourselves into that initiative. So we're really lucky that we've got ICDM taking this initiative, because there's a lot of hard work to try and get all of these IODs together. Indeed. And of course, at launches like this, we also have the opportunity to reach out to IODs in Asia Pacific region, which is great. Because when we are speaking about climate needing to be mainstreamed, directors as long-term stewards, they really need to recognize that businesses face multiple headwinds. And I'm not entirely sure if the levels of awareness are there yet. To date, Malaysia is still the only country chapter of the Climate Governance Initiative in Asia Pacific. So we're really pleased that Australia, hopefully Singapore, Hong Kong will be coming on board soon. But this is a conversation that's urgent. If you think that the overwhelming majority of scientists recognize the direct causality between human actions under cover of corporations and limited liability and the massive polluting footprint that is causing this crisis, and layering on much more independent reporting on the effects and the implications, whether it is the Independent Energy Agency or the International Monetary Fund, even scientists coming out to say that we actually have until 2030, not even 2050. We're seeing a massive diplomatic push prior to COP26. Some countries are weaponizing ESG and halting goods without full disclosure of reasons, for example. And of course, this is all happening against a backdrop of critical components falling into place. International disclosure standards, SASB IFRS Foundation, the recent SEC consultation, of course, Bill Winter's Task Force for Scaling Voluntary Carbon Markets. The NGFS now has 92 members and 14 observers. This has scaled up tremendously. And of course, this is all in the last 12, 18 months, but in the last few weeks, we've been hearing that governments and courts are taking this very seriously, whether Exxon or the Dutch court instructing Shell, Chevron. So the very real risk that directors in the region are having to consider is that the real tsunami might not be the climate emergency, but capital markets, people like BlackRock, pulling this risk forward, leading to a downgrade of ratings, withdrawal of reinsurers, your currency weakening, your cost of debt increasing. So all of these are very real economic financial risks that we might start off by categorizing it as climate risk, but it has a very real impact on businesses and industries.
Brilliant, and couldn't agree more. Just as a side anecdote, I was having a conversation with the chair of a board of a European company the other day, and he referred to the alphabet soup of ESG because there's just so many acronyms, and sort of trying to figure that out itself, it requires considered attention there. But maybe coming to Sarah. Sarah, so we've heard some comments from Amar and Sunita. And then question for you is, what implications do some of these comments have for the way that directors' duties, or for example, the duty of care, duty of loyalty, etc., may be interpreted? To what extent do broadly held views in the investor community, the scientific community, etc., play into what a reasonable director would be expected to do?
That's a really good question, Shai. It's really important to remember that the test of due care and diligence across all jurisdictions is not what does a director know, it's what should a reasonable director know, what ought you to have known. And all of these factors, these soft law factors, the demands of investors, the soft law guidance of regulators, shifts in markets, they all go to elevate the standard of conduct that is expected of a reasonable director. If anyone has a director in court, in the witness box and under cross-examination, is trying to argue currently that they oughtn't to have known that climate change here and now is a foreseeable financial risk, please invite me. I'd love to see that interrogation. It is indisputable. Factors we can look at: the Paris Agreement back in 2015. Never before has there been a signal from 196 countries around the direction of regulatory travel towards net zero, towards limiting global warming to well below 2 degrees above pre-industrial averages. There's a reason they call it the mother of all market signals. We can look at the World Economic Forum for the last 3 or 4 years having rated a failure of climate risk governance as the #1 economic risk to the global economy. And actually this year, if you look at the WEF list, despite COVID, 5 out of the top 6 risks to the global economy are directly associated with climate change. So when boards often ask me, so how much should I be thinking about this issue in order to discharge my duty of due care and diligence? I say, well, a general rule of thumb, take how much time you've thought about COVID and times it by 5. And that's just a very base rudimentary formula for how significant this issue is potentially for your business, let alone the expectations of investors, BlackRock included. I think there's now more than 40 trillion worth of asset management money in the Net Zero Managers Alliance. The list goes on and on and on. So I think directors should be very conscious and cognizant of making sure that they are regularly receiving briefings on this issue, because it is material and it's dynamic and accelerating.
Brilliant. So in other words, if 5 or 10 years from now, and I'm asking this tongue in cheek, of course, but in 5 or 10 years from now, someone were to accuse a director of having failed to take adequate action on climate change, would it be a credible defense to say that we didn't know then, as in 5 years ago, what we know now? Is that a credible defense?
Shai, you don't often get an unequivocal answer from a corporate lawyer, but in this case, that is not a credible defense.
There we go. And another first in this panel, a one-word answer from a corporate lawyer. Brilliant. Thank you, Sarah. Amar, just then question for you. What evidence have you seen that board directors are becoming sensitized to the urgency of the climate crisis? We heard Sarah talk about sort of some of those data points, and BlackRock, it's exemplary itself in its focus on climate transition. But do you see signs that this is influencing corporate culture and strategy?
I would say it's still very patchy, very patchy. You have certain markets in APAC, Australia being the prime example, where activism on climate issues is strong. You have proposals on, say, on climate, etc., that companies are voluntarily adopting. And a lot of that follows the trend that we're seeing out of Europe and UK. I think Europe and UK tend to set the lead, if you like, and then other markets like the US and Australia, etc., follow. Outside Australia in this region, I would say the evidence is very scanty. I don't think companies and their boards are paying enough attention to this. And one way of pointing this out is this alphabet soup of various acronyms. I think a lot of board members would be hard pressed to give the difference between ESG and CSR. And if you don't have that clearly in your mind, I think there is a risk that you're not discharging the responsibilities that you have to your shareholders on environmental, social, and governance issues, not just corporate social responsibility that tends to focus on which charity the chairman's wife is the patron of, right? And people, a lot of board members, when you ask them what are they doing on ESG, oh, you should look at our corporate social responsibility page in our annual report, and we contribute 2% of net profits for CSR efforts. There's confusion on what ESG and CSR and other acronyms stand for. But I think that's one basic area that if directors cannot tell you the difference between ESG and CSR, and my bet is more than half can't in the rest of Asia, ex-Australia, then the knowledge base on these issues is actually pretty low.
That's a great point. And I like, again, these sound bites. ESG is not CSR, and any director who confuses that is probably not appreciating the full importance and prominence of ESG as a business imperative and a business strategy, whereas CSR is considered as an altruistic corporate giving as opposed to sort of it being a business impediment. Thank you, Amar. That was great. Sunita, maybe just a question to you then. So you touched briefly upon this earlier, but you have chosen to start up Climate Governance Malaysia. So I appreciate that you may not be representative of the larger community of directors around you. But how have you grappled, have you yourself grappled with how to reconcile your legal duties to do what's right for the company with what the scientists say we all should be doing to safeguarding the planet? I mean, what arguments have you heard from fellow directors who are making a case for not taking action, and how do you try to convince them?
Thank you, Shai. I think this is such an important question and a really, really difficult question, and something that I grapple with all the time. Because, especially as a non-executive director, although the law doesn't differentiate, but I am one amongst my peers. And, I work with peers who are bright, intelligent, experienced people in their own right. And so I think raising levels of awareness is something that the regulators have been working on for a while. The stock exchange launched FTSE for Good ratings a full year prior to Paris. And we've had multiple guidelines of sustainability. The taxonomy for the financial institutions are very clear about categorizing your credit portfolio. The Code on Corporate Governance was updated to include a whole note on sustainability, but it is a very complex conversation. And it's not as simple as just running into a boardroom and saying, guys, we need to do this. Because, there are different perspectives, there are different points of view. But one thing is clear, the cost of inaction is going to be significantly more than the cost of action, whatever it is. And it's going to be very difficult for industry to argue that climate risks are not hugely material. I don't think we need to wait till 5-10 years out for litigation, because that's already happening right now. This is going to affect how accounts are being drawn up, where maybe people will have a direct line of sight that corporate profits are being misstated if they're not taking into account the social cost of this pollutant, which is causing so much existential risks. And so the climate emergency, decarbonization, it affects all of us. The energy transition, which the entire world has committed to implement, is rewiring our economic DNA. And it's hard to see how any sector is going to be untouched. And being clear today also means that capital will be deployed to where it needs to go, whereas lack of disclosure might boost those sectors which are actually challenged by decarbonization. And so, while we see investors are mobilizing as never before, and they're asking for credible transition plans, which are going to reveal the leaders and the laggards. But I do have to concur, in this part of the world, the conversation is still very nascent, still at a very early stage. And that just means more work for all of us, that we all have a role to play.
True that. Well said. We all have a role to play. And particularly, I think the points made by all three of you are well noted about the differences in maturity, prominence, acceptance across Asia Pacific. I moved to sort of Singapore 12 years ago, and colleagues globally would often ask, you work in Asia, what's it like over there? And my first response is, there is no one Asia, right? We are such a varied geography and varied practices. But then maybe question, Sarah, for you. Very kindly earlier, you spoke about what are the commonalities in this primer across multiple jurisdictions. But as we think about different countries and their alleged competitive advantages and different stages of maturity, is this an area where regulatory inconsistency could actually create competitive distortions?
I don't think so, Shai. I think because the regulatory landscape is really itself catching up with market expectations. So if you're on the board of a company where you are governing to legal minima, you're going to be behind the 8 ball in terms of market expectations in the first place. The wonderful things about whether it's the real economy or particularly capital markets is that they're global. And the leadership here is being taken by investors in a very large part, by large asset owners, asset managers. And so I think boards would be well advised to consider not the lowest common denominator and try and get some kind of competitive advantage based on where they're located, but actually look over the horizon to, well, where is the highest common denominator at the moment? Because that is really the direction of travel that markets are accelerating towards.
Well noted. Understood. Thank you. And I think that is good counsel, that legal minima will sort of not be enough or not be aligned with market expectations. And I guess this also touches on a question, which is the role of investors versus the role of legislators. And in any question of this nature, it's never a question of or, it's always a question of and. So that both sides need to play a role here. So that point is well noted. Maybe just shifting gears a little bit to disclosure, and Amar, I'll start with you. So disclosures, whether due to regulation or due to the emergence of voluntary best practice frameworks, disclosures have arguably received a lot of attention, and some would argue disproportionate attention. After all, disclosure is not an end in itself, but a means to an end. So should that end be? So I guess the question is, what should the end be in your view, beyond just disclosures? What role do you think disclosure standards can play in driving climate awareness on the part of directors?
Look, I would say disclosure is a very important means to an end and various ends, because disclosure is about what you're measuring and then what you're reporting. And if you don't measure something, it's very hard to manage whatever it is that you are not measuring. And so when you're looking at the impact that companies are having on climate and the environment, if companies are going to make any progress, they need to be measuring the impact right now and then setting targets where they might be in the next 5, 10, and 20 years down the road. So disclosure comes hand in hand with measuring and reporting, which are key. But there is another aspect that is important for asset managers on disclosure, which is that there is confusion and incoherence in the ESG rankings of the third-party providers of ESG ratings, MSCI, Sustainalytics, etc. When you bring their rankings of companies and you compare it, the correlation in ESG scoring is almost zero. Not quite zero, but not far from it. And the reason why it is almost zero correlation between these so-called experts on ESG is the data is bad. And when the data is not there from companies, then the companies that are doing the ratings have to interpolate or extrapolate. In other words, guesstimate what is not there. And if companies are letting these ESG rating agencies guesstimate, then you get this incoherence. The only way around the incoherence is that disclosure has to improve from companies so that there's less guessing. And one other issue I would emphasize is the measurement and information coming to directors on the board. The key question that directors need to be asking is, are they getting the right information? Are they getting the relevant information for them to be discharging their duty of oversight on management? And to discharge that duty, they need to know what metrics they should be looking for in relation to climate risk. And we can give some suggestions. Essentially, BlackRock is recommending both TCFD as a framework and SASB, Sustainability Accounting Standards Board, as a standard setter for 77 individual sectors. It tells you what you should be looking for as a director.
Thank you. I think that there's a lot of really important insights in what you just shared. And I couldn't agree more with sort of this notion of what gets measured gets done. I'll go one step further, which is what gets measured and gets rewarded gets done. And this is my plug to the World Economic Forum and Climate Governance Initiative. So Willis Towers Watson, we're partnering with the World Economic Forum and Climate Governance Initiative and actually coming up with a guidebook on how best to align executive compensation and climate transition, climate incentive priorities. Because then you go from that step one, disclosures and setting the right targets, and then step two, aligning it with incentives and driving the organization towards that. But I think this point is very important. And thank you, Amar, that was helpful. I did not realize that there was almost zero correlation between all these different standards. So you learn something every day. All right, I know we're getting sort of close to 15 minutes left. So I will open up to the chat for questions. And there have been a few questions in the chat. Maybe we'll start with one of the first ones, which was that a lot of what we've been discussing, is it related to listed companies or public companies? And I suspect the answer would be that it's related to all companies, irrespective of listed or not. But question to any of the panelists, are there specific nuances that private companies or family businesses need to pay attention to as opposed to listed companies? Sunita, maybe is there something from your experience that you'd like to share?
I think Sarah will be able to weigh in about the legal responsibility.
I was going to say, Shai, the directors duties are universal, whether it is public companies, private companies, or actually also public sector in the large part as well. If you're on the board of, say, for example, a government-owned corporation, sometimes the enforcement mechanisms are different. For example, if you're on the board of a government corporation, sometimes it's only that the minister can bring enforcement proceedings against you. The only other difference is usually in the area of disclosure, because private companies don't have the same obligations to be publishing annual reports, financial accounts, directors' reports, etc., etc.
Fair enough. Fair enough. Thank you. I think there's some really excellent questions here. So I'll just read one of these out, saying, which is trying to bring an industry lens to some of what we've been talking about. So how do you suggest, the question is, how do you suggest that directors of companies primarily invested in carbon-heavy industries, either through their investments or operations, adequately fulfill their directors' duties in light of the shift in recognizing the financial risks of climate change? And then the follow-up question is divestment the only prudent way forward? Amar, maybe we'll start with you on this one.
Yeah, sure. Look, the technological challenges for a number of sectors, including steel, cement, shipping, airlines, the economics of moving to zero carbon processes and production systems, etc., are still exorbitant. I think the first responsibility of any director is to be up to date on how the technology is evolving, because in certain areas the cost of greener processes are falling very, very fast. As we know, batteries and solar panels, etc. That part of the cost is falling very quickly. So it's very important for directors to know how the cost curve, if you like, is shifting relevant to the sector that the company is operating in. I think the knowledge base is evolving, and it's really incumbent on directors to be up to date.
Fair enough. Fair enough. And just as a protocol, any panelists, please feel free to jump in at any question. Please go ahead.
I can just jump in. In a few hours' time, CGM is co-hosting another webinar where we have the CEO of Scania. And he's moved in from one heavy industry to another industry. And they're very determined, not just about carbon footprints, reducing carbon footprints, but embedding sustainability into the DNA of the business. So if you're saying that this is an existential risk, then it is also a huge minefield of opportunities coming up, commercial opportunities, because there's tremendous value that can be created.
Absolutely. And I guess the question around divestments, companies need to think about that a little carefully as well, because divestment is not necessarily solving the problem. You're just making it somebody else's problem. Right? You're taking it off your balance sheet and your asset base and moving it to somebody else, but the net pollution is still the same. So the longer term solution is actually investment in technology and applying new technologies, not purely divestment. But fair enough. I know sort of that itself could be a very long discussion. Maybe a question, Sunita, for you, because this is related to what we see in ASEAN, where there is a comment that unfortunately there is not much of political will to ensure compliance with climate change laws across ASEAN, or at least not much of it is public knowledge or being disseminated for public consumption. So I guess the question is, should climate change policy be made one of the items in the checklist for companies? And if they fail, then they sort of entail censure and follow up. In Malaysia, one of the biggest polluters or emitters, I should say, is palm oil plantations. Are there any best practices modules that can help these plantations and the directors of these plantations to discharge their duties?
Okay, so in terms of ASEAN, I know there are a lot of initiatives on a regional level that the regulators have already been working on. Namely the prudential regulators, central banks, and also the securities commissions. So they've been busy working on frameworks, taxonomies that could be used across the region rather than everyone replicating efforts. And I think that's a tremendous initiative. And I'm hoping that when we launch the ASEAN chapter, we will also be able to collaborate closely with that. In Malaysia, we've already started what is called a series of roundtable conversations, because I think there's recognition from the government that this is a series of crises that has no silver bullet. And it's not a sprint either, it is a marathon. And it's not just a race, it requires everyone crossing the finishing line. And so government has recognized that it needs an all of government, whole of society approach. And we're having this series of roundtable engagements, initially on a sectoral basis, but we hope this is going to end up being a permanent feature of engagement between government and whole of society to discuss policy recommendations that could be implemented should the government want to consider increased climate ambition.
Fair enough.
This is something where everyone can play a role in this conversation.
Brilliant. Excellent. Thank you, Sunita. Question for Sarah. So the question is, how are law firms helping companies and directors be more aware of climate-related financial risks? What kind of questions are you hearing from clients asking for advice when it comes to relation to climate change?
Well, if you think about what the function of lawyers are, we're essentially risk managers. We assist our clients to manage risk. Corporate governance is one subset of that risk, and climate change is a key financial risk. So our role as corporate governance risk advisors is basically to ensure that our clients are aware of the evolution of climate change from what might historically have been considered a non-financial environmental issue to one that does present material and accelerating financial risks and opportunities. If we don't do that, we're not doing our job as key risk advisors to boards. So it's not our role to be alarmist. It's not our role to stand on the corner in a koala suit. I'm Australian, so we would have a koala suit if we were to do that. That's not our role. We are objective risk managers, and it is a key part of our role to be advising boards how this shift has occurred and continues to occur, and assist them to join the dots to what that means for their strategic role, their risk oversight role, and potential liability exposures.
Thank you. Completely understood.
Maybe I should add the incentive for companies to take this seriously.
Yeah.
Again, quoting our chairman, Larry Fink, we at BlackRock think that we are at the beginning stages of a tectonic shift in allocation of capital towards companies that get it, if you like, in terms of climate issues. The growth in ESG and sustainability funds is fast outpacing the growth of funds in traditional investment strategies. At BlackRock, at the beginning of 2020, we had $100 billion in high ESG and sustainability strategies. Our target is to grow that by 10 times in 10 years. And that's a compounded rate of about 26, 27% per year. We're growing faster than that. And that growth in high ESG and sustainability strategies is growing much, much faster than the traditional old style investment strategies that are still there on the platform. What that means is that new capital coming into capital markets will be looking for companies that are ESG compliant, if you like. And those companies will see the fund flow and the valuations go up. And I've said it a few times before, I'll say it again. November last year, KEPCO in Korea, as well as Samsung C&T, the construction arm, as well as a few of the finance groups in Korea, announced no coal policy going forward. The result of which, KEPCO is the equivalent of Tenaga in Malaysia, a boring old utility that hardly goes up year on year. But from that announcement in November to December, KEPCO stock was up over 30%. And the KOSPI index was up also 30% between November and December 2020, the best performing market in Asia. There's a huge incentive for corporates and for regulators and capital market policymakers to get the companies on the right track to attract the capital where it is shifting.
Perfect. Thank you, Amar. Look, ladies and gentlemen, I know we have tons of questions, and unfortunately, we're not going to get through all of them. We have 5 minutes left, so I'll try to do one last question to each of the panelists. But just a quick clarification. Earlier, when I mentioned that the palm oil industry may be the greatest emitter, that wasn't my view, or sort of I was reading the question out. We have not fact-checked that, whether palm oil is indeed the biggest emitter or not, but it is among the bigger emitters. But putting that aside, maybe one last question to each of the panelists. And slightly different question. Sunita, question for you. From a director perspective, is every director expected to become a climate expert? And how do you avoid this notion of greenwashing? Sunita?
I'll take that question. So climate expert, I think you need to be climate literate. If you really think that this is an existential crisis, then there's no director that will be absolved by saying that I thought that someone else was looking into this, because it's going to affect so many aspects of your business. And this is why the Climate Governance Initiative is so important. Governance of this key risk that's going to affect the survival of your business and your industry. And if that isn't important enough for a director to apply their minds to it, so I think the question is not well worded. It's not that you need to become an expert. All of us are going to have to be making much more mindful choices, whether as an individual, as a household, as a community, a society, and definitely as a business, as an industry, and as a country. We're all going to have to step up. So it's not as though we're saying, okay, Shai, you please think about this for me. And then it's not something that you can outsource or delegate. And to be more specific, we need to start off by measuring, because as Amar said, unless numbers are aligned, behaviors are not going to be aligned, and we're not going to see the change that we want to see. And once you start measuring, then you can work out, how can I reduce this as much as possible? Not just carbon footprint, but wastewater, energy efficiency. And then at some stage, you're going to start thinking, can I benchmark these efficiencies or set targets, whether it's science-based targets, for example. And then at some stage, you are going to realize that disclosure is not enough, that we actually need to embed circularity and sustainability into the DNA of the business. This is not just a zero regret investment decision, but it also ensures that the entire board is sending a strong tone from the top of keeping an eye out for opportunities. So climate governance needs to be layered on throughout the organization, not just a tone from the top, but aligning executive compensation. And when you look past declarations of ambition for many companies, I think you'll be able to see which are the ones that are clearly articulating their roadmap, their direction of travel. And this is also a proxy to the quality of management and directors.
Brilliant.
So the tipping point is going to come very, very soon, at which stage no one is going to buy your goods, no one's going to invest in you, no one's going to lend you money, no one will want to work for you. Yep. If this isn't something that every director is concerned about, then I don't know what they're doing on the board.
Good counsel. Thank you. And that's a good call for action. I have one last question each for Amar and Sarah. Amar, I'll start with you. Very quickly, are investors ready to take companies to court for inaction on climate issues?
Look, there are different investment strategies, and there are activists that take directors to court for negligence, etc. If a stock's been underperforming for many years. BlackRock's approach is voting against directors. We have our list of our climate universe, which is about 1,100 companies of our total coverage. And for those companies in carbon intensive sectors, including banks that we add into the list, if the companies are not providing disclosures and targets and moving towards TCFD framework, then we would vote against directors for not providing the disclosures that we expect of them.
Brilliant. Thank you. Sarah, one last question for you. And I know it's I wanted to deliberately end with this. What is the greater risk for directors? That they may face personal liability for taking actions that compromise the company's near-term profitability, or that they may fall short of their obligations relating to good climate governance and disclosure of the company's issues that affect the company in the long term?
Well, I think you can probably guess what my answer to that is going to be, Shai. And it's not just a personal view that I held, but let's look at the data. Let's look at where the cases are being filed. The cases are currently being filed against directors for a failure to consider climate-related financial risks. Now, again, though, I have to emphasise this is all about robust process. This is about making sure that the inputs and the diligence that you apply to making a decision are fit for purpose, fit for a forward-looking purpose in a world that has changed and continues to change. So I think a director need not fear litigation as long as you make sure that you have adjusted your inputs, your strategy, your deliberations for a world that is altered by climate change, whether it's physical risk or economic transition risk.
Brilliant. Thank you. Thank you, Sarah. I know we're over time. I'll try to summarize this in a few bullet points, but on behalf of all the participants, panelists, thank you for making the time. This was an excellent conversation. Few key takeaways completely as bullet points. Number one, as a matter of law, some of these concerns that directors have are unfounded. Number two, climate risk is an investment risk. How much time should directors be spending on this? Think about COVID multiplied by 5. It is not a good defense to say we didn't know about this 5 years from now. ESG is not CSR, and that's a key takeaway. Capital will be reallocated based on companies' climate priorities, and we'll expect tectonic shifts in investments. And both investor community, director community, and the regulatory community will need to work together to affect some of these changes. So with that note, I think this has been a fascinating conversation. Thank you to all the panelists. I've learned a lot. We've not able to answer all the questions, but please reach out to us offline and we'll try to address any of the questions. The primer, the legal primer, which was the subject of today's discussion, that will be available online. And I know Sunita is going to share a slide that summarizes where you can find that. But again, on behalf of everybody here, we still have 100+ participants. Thank you, panelists. This was great. Really appreciate it.
Thank you so much, Shai. Thank you.